Today for the SIE exam, we are going to break down put options, focusing on the rights they grant and the common strategies you'll be tested on. A put option is a contract that gives its owner the right, but not the obligation, to sell a specific amount of an underlying security at a predetermined price, known as the strike price, within a specified time frame. The key phrase here is right to sell. The buyer of the put pays a premium for this right, and they are hoping the market price of the stock will fall below the strike price. This makes buying a put a bearish position. Think of it this way. If you have the right to sell a stock at $50, but the stock is currently trading in the market at $30, your right is incredibly valuable. You can effectively sell the stock for $20 more than its current worth. Let's walk through an exam-style example. An investor is bearish on XYZ stock, which is currently trading at $48 per share. They buy one XYZ October 50 put contract for a premium of $3 per share, or $300 total. This contract gives them the right to sell 100 shares of XYZ at $50 per share any time before the October expiration. For the investor to profit, the stock price needs to fall enough to cover the cost of the premium. The break-even point is calculated by subtracting the premium from the strike price. In this case, $50 minus $3 equals a break-even of $47. If XYZ stock drops to $40 at expiration, the investor can exercise their right. They can buy 100 shares at the market price of $40 and immediately sell them at the strike price of $50, making a $10 per share gain. After subtracting the $3 premium, their net profit is $7 per share, or $700. The most they could have lost was the $300 premium if the stock had stayed above $50. A common trap for test takers is confusing the buyer's rights with the seller's obligations. The put buyer has all the control. They have the right to sell. The put seller, or writer, has the obligation to buy the stock at the strike price if the buyer chooses to exercise. The seller is hoping the option expires worthless. Now let's talk about a crucial strategy called a protective put. This is a hedging technique used by investors who are long a stock and want to protect themselves from a potential decline in its value. It's essentially portfolio insurance. Imagine you own 100 shares of ABC stock which you bought at $30, and it has since risen to $60. You have a significant unrealized gain, but you're worried about a potential market downturn. To protect this gain, you could buy one ABC 55 put option. If the stock price plummets to $40, your stock position loses value, but your put option becomes profitable, offsetting much of that loss. You've locked in a minimum selling price of $55, protecting your downside risk while still allowing for unlimited upside potential if the stock continues to rise. The cost of this protection is simply the premium paid for the put. To help you remember the core concept on exam day, use the simple phrase "put down." When you buy a put option, you want the price of the underlying stock to go down. This mental shortcut helps you quickly identify the investor's market sentiment. Buying a put means you are bearish, expecting a downturn. This is fundamental to correctly answering questions about why an investor would choose this specific type of option.